Hi, welcome back to another edition of Lippers Fund Flows Insight. My name is Tom Roseen. Thanks for joining me today. I'll be reporting flows for the conventional fund business originally, and we'll talk about ETFs a little later on, for the weekend of Wednesday, April 25th, 2018. You know, we had kind of a really topsy-turvy, and I'll be more of the turvy portion of this week. We had a lot of news come out, really strong earnings reports. About 81% of those S&P 500 constituents that reported beat estimates. We had actually good economic numbers, but what really put people into a tizzy was to see that the 10-year Treasury yield actually went above 3%. Went up above 3%. Actually, it was 3.02% on Wednesday. But that's the highest that we've seen the 10-year Treasury bill go since, I think it was December 27th, 2013. And it's got a lot of people pretty scared that there's going to be a lot of disintermediation, money coming, out of bond funds and no place to hide because equity funds are so frothy. But it was really kind of a unique event this week because we actually, after all this disappointing news, if you will call it that, we actually saw inflows, about $6.4 billion for the week. It's the first week in 3 we've actually seen net inflows. So again, a little bit of a head scratcher, but I think it is because the market has been doing so well. When I say the market as a whole been doing well, the stock market hasn't done all that good. We saw the NASDAQ actually lose 4% this week, so that was a really big loss. But nonetheless, again, as I said, we saw inflows. Let's go ahead and talk a little bit about each of those macro groups to see how that panned out from this week's news. If you take a look at our market macro groups, we see equity funds took in about $1.9 billion. That was a very strong inflow considering what happened, what the markets were doing, really kind of a dour down week. Taxable bond funds saw about $900 million in net new money come into their group. Muni bond funds saw $242 million come into that group. And money market funds saw about $3.3 billion. So all 4 major categories took in money this week. Again, despite having the 10-year Treasury go above 3%, which was considered by some to be kind of a high water mark, so to speak. But again, let's go ahead and detail now and take a look at the macro groups one by one to see how it really panned out in detail. Looking at the equity funds, we basically saw that they lost about 2.42%. Again, took it on the chin this week overall. First week in 4 that they've seen negative returns. Again, 2.42% is pretty large for a week. But again, $1.9 billion in net new money came into the group this first week in 5. We've seen net inflows into the group. And if we take a look, we saw domestic equity funds actually for the first week in 9. Pat and I have been talking about outflows for the last 9 weeks. First week in 9, we saw $319 million inflows. Not a lot to write about, but again, at least a little change of pace. They saw a minus 2.55% return or loss, if you want to look at it that way. Now, on the non-domestic side, they actually continue to take money in, about $1.6 billion. 6th consecutive week that they've taken in net new money, and it's the first week in 4 they've actually seen a negative performance, and they lost about 2.18%. So again, a little bit of a head scratcher. People actually are putting their foot on the pedal, and maybe turn out to be a bright thing to do, buying on a dip. Maybe that's what we can call it. Large cap funds actually took in money. I've been talking for months on end how a large cap's been handing back money. This time they took in about $730 million. That's something to write home about. That really is quite a change. Again, they've been the pariah probably for the last year and a half. Large cap funds have. International equity funds actually continue to take in money. That has been a long-going story. Basically about $1.3 billion this week that they saw come into the coffers. Now let's go ahead and turn our attention towards the ETF side of the equity business, and basically we're going to see a little bit more subdued, ETF front. Basically, we've been seeing $5, $6, $7 billion net inflows. This week we saw for the 3rd consecutive week inflows, but only to the tune of about $1.7 billion. iShares Core S&P 500 ETF basically saw the largest share come into the group, about $1.8 billion. And iShares Core MSCI Emerging Market Fund also took in money, about $1.3 billion. At the very bottom of the heap, we saw the PowerShares QQQ Trust 1 actually lose the largest amount, about $1.9 billion. And then the second lowest was the iShares Russell 2000, which saw about $1 billion, a little bit over $1 billion of money flow out of their coffers. So again, a little bit more subdued, but still on the positive side. And again, so it wasn't just retail investors, it was also authorized participants putting their fair share into net new money coming into the group. Let's go ahead now and turn our attention to the fixed income arena. Now, this is one of the areas I would have expected to actually see outflows, right? We had yields going up, we had people talking about inflation and those concerns, but for the third consecutive week, we saw net new money come to that group, $926 million. First week in 4 that we've actually seen new money coming into the group on the open-end side, and they lost about 1.01%. Now, that doesn't sound a lot. That's for a week for a fixed income fund. That was a lot. Kind of surprised. Where the money went, though, is international and global debt funds actually took in $985 million, and it's the 8th consecutive week they've seen net new money come to that group. And corporate investment grade debt funds continued on their merry way upward as well, taking about 8.22, let's call it $822 million. So that was quite a story. At the bottom end of the group, though, and this kind of goes hand in hand with a real poor equity market and people kind of afraid of inflation and not being able to borrow, high yield funds lost $491 million, and we saw that our government mortgage funds actually saw about $226 million in outflows. So kind of a story there, something to talk about, a little bit of a change, but again, kind of a head scratcher. We saw inflows in pretty handsome inflows at that into, again, corporate investment grade and also into the international and global debt fund group. Let's take our attention now and move it towards the fixed income side of the ETF universe and see what happens there. Basically, it saw just a minute bit of outflows. I would almost call it a rounding error. $4 million in outflows. It's the first week in 5 that they've actually seen outflows in the fixed income universe, but at the top of the universe, and this is a little bit of a head scratcher with yields going up, the iShare 20 plus Treasury bond ETF actually took in the largest amount of money, $597 million. iShare's core U.S. aggregate bond fund ETF took about $584 million. And then if we look at the very bottom of the group, we saw the iShare iBox dollar high yield bond ETF lose about $1.1 billion. Again, it was pretty much a push, negative $4 million, It's not a rounding error, but certainly it's just not a lot to write about. Let's go ahead and turn our attention now to muni bond funds. Muni bond funds actually saw inflows. Second consecutive week they've taken in money, but the first week in 4 they've seen a negative return. This time they lost about 0.52%. As I was saying on the fixed income side of the universe taxable, they had that 1.01%. Well, 0.52% loss on a weekly basis is a pretty big loss. Nonetheless, again, the group took in about 242. If we look at the high yield muni funds, this is one of the areas that they actually turned away from what the taxable investors did. High yield munis took in the biggest chunk, about $177 million came into that group. Now let's go ahead and turn our attention to money market funds. Now the money market funds, as we're taking a look at those, basically the first week in 3, they've actually seen inflows. And this is as expected. This is what I would have expected. A little bit concerned with what the market's doing, nowhere place to hide. Yields going up, bonds are not a safe haven. People are saying equities are getting a little frothy. I would have expected money coming into the money market fund. First week in 3, though, that we've seen money come into it, $3.3 billion. How it broke out, taxable money market funds, so about $2.5 billion. In net new money coming to their group, and tax-exempt money market funds took in about $831 million. If we go into a little more deeper focus on the taxable money market side, we see institutional investors actually added about $8.7 billion, but then we saw that the retail investors actually took out about $6.2 billion. That brings us to our the $3.3 billion as far as net inflows go. So $2.5 billion went into the taxable money market funds, and again, that's to be expected. Well, that's it for me. Basically, if I didn't do a deep enough dive for you, you can go to our site at www.lipperusfundflows.com, or you can join us next week where one of our analysts will be talking to you about the flows. But I will remind you to keep an eye on what the market's doing. Obviously, we're all going to be concerned about where the 10-year Treasury goes. Another place that we can pay a little bit more attention is we just saw March durable goods orders come in at 2.6%. Again, good economic numbers, very strong Q1 earnings numbers coming out. So maybe we'll have a little change of heart and people will, jump back in the market. Who knows? But join us next week when one of our analysts will talk about those flows trends. My name's Tom Roseen. Thank you for your attention today, and wishing you the best in your wealth planning and creation.